Welcome to the daily update, where I'll go over the action in the market for Friday, December 6th, and we'll see how things look for Monday, December 9th. Set another all-time high with the S&P, the Nasdaq 100. The mega caps and the large caps are really controlling the market right now as we see the rest of the S&P and some of the broader market continue to show weakness. So we keep an eye on the mega caps and the large caps because if they start to come under any selling pressure, that could really make the indexes vulnerable. We're dropping down a little bit as far as sentiment. We're back to neutral right now. So we're not looking extreme, at least according to the measure that we look at here. But when you take everything together in the short, intermediate, and long term, we're looking positive. But as always, there are some things that we are a bit concerned about. For the rest of 2024, the SPX Investing Program is free, and there are additional videos that I post there. There is an updated version of the basic course. In 2025, I'll be rolling out other courses, well over 100 hours, that I will post at the beginning of 2024. And I like to keep these videos as up to date as possible because I use a lot of current charts in them. But for right now, please feel free to check that out. There's a link that'll take you to the website as well as to a video that talks about the program. If you have any questions, please send me an email. And one benefit is that you get immediate access to these videos as they are uploaded. Also, the daily video, which is what you're watching right now, this is the real foundation of the analysis that I do. Now that we've hit the weekend, I'll be doing the outside videos, but they're all meant to tie into the daily video. Okay, let's go back and talk about what happened. We had a higher open. We had the employment situation report come out, and it was treated as positive. It came in a little stronger than expected and much improved from what we saw last month when it really shocked the markets that it came in so weak. So, right out of the gate, we were able to go up with price, but we hit resistance right at that 6,100 level. It's not a technical level, it's a psychological level. And actually, R2 for the day was right above that level, and we never got to that point. And the 6,100 level that we hit ended up setting the intraday high. Then we declined. We got back down below R1 at 60.89. We found support at the daily pivot at 60.81 before climbing back above R1. Of course, then we went back below R1. We tested the daily pivot again, and then we were able to bounce up off of that and close slightly above R1. So there was not an awful lot of conviction that went into Friday's session, but it was still positive. We were up just 0.25% on below average volume, which again is strange. Biggest economic report of the month, and we don't see any real price movement, and we actually dropped below average with volume. So, taking everything together, we are still positive though in the short, intermediate, and long term, but there are some things that we're concerned about, and I'll go through those charts. It does look like the Fed is going to come in and cut rates. That the probability is a lot higher now, and that will be on December 18th when they make that announcement. And Friday's report, at least as of right now, suggests that there could be another rate cut. Now, in the upcoming week, we're going to have CPI and PPI coming out, and those are the inflation gauges that we look at. We'll see how they act, and if that confirms the idea that the Fed could still come in and cut rates. A lot of things happening geopolitically, but not really having any kind of an impact on the market anyway. Okay, the S&P, the Nasdaq, and Nasdaq 100 again set new all-time highs. The Dow did not. It ended up being down. There was a pretty muted response to the employment report, but it was taken as positive. And we're dropping down now with the VIX. We're below 13. We're getting into the 12 range, and that's a pretty low reading, which means we're getting to that complacency area, and we want to be a little careful of that. We're not seeing that with sentiment, but we are seeing it here with the VIX. Mega caps, large caps, and growth did outperform. And as I mentioned, this has been the stronger area, at least this past week. We're not really seeing continued advances with the mid caps and the small caps based on the indexes. Now we're seeing an improvement with growth over value, and that could help the mid caps and the small caps. But if there are some folks that come in and want to start taking profits on these really big companies, that could make things kind of vulnerable. Okay, we still have a non-confirmed Hindenburg Omen. The broader market, and when I mean broader, I'm meaning the rest of the S&P as well as the NYSE. They're not really seeing an awful lot of strength now. In fact, we're seeing a little bit of weakness actually developing. Here's our short-term list. We're coming down with the VIX, which means we're going kind of fast now. So we're getting kind of extreme with that reading. And then we have the things that have been on the list for a while. The Stochc RSI, the Williams Percent R, CCI 14 and 20, and the stochastics. These are the usual indicators that when we're moving up or down, it's very common to see them getting extreme. And it just confirms right now that we're seeing good momentum. But at the same time, we want to look at these as saying, okay, we're getting maybe a little overextended to the upside. And then another one that was added back on this list is that we're getting kind of far away from the 20 period moving average. That's the boom 20. And then the short term RSI is also looking extreme. In the intermediate term, another new addition to the list is the balance of power. We don't see that extreme very often, and it's giving us a pretty extreme positive reading right now. The CMB composite, it declined a little bit, but we're still getting an extreme reading there. It's been on there for a few days. The Sean trend meter also declined, but still looking extreme. We're still up into that +3 channel with the standard deviations chart, and that's suggesting we could be going up a little too far too fast. And we still have the bullish percent indexes for the S&P and Nasdaq 100. Another new addition to the list is a secondary indicator, the money flow index, and we're also getting kind of far away from the 50 period moving average as measured by the boom indicator. And I did make one little change here to the scenario. It does look like the Fed will come in and do another rate cut at the next meeting. Now, that could be changed if CPI and PPI come in hot or weak or something to kind of rattle the current scenario. The dollar was up and interest rates were down. We ended up closing at 4.15% with the 10-year yield where we had been at 4.18%. And the 10-year yield coming down has been giving support to stocks lately. We're still inverted with the 10 to the 3 month. We're still uninverted with the 10 to the 2 year. That doesn't seem to change these days. And as far as sentiment, we're back down to neutral. We had been just ticking over into the positive area at 56. We're actually ticking down into 53. So we're kind of shooting the middle there. But sentiment has been actually declining a little bit, which could be taken as somewhat negative as the rest of the market isn't really participating right now. We are positive with the trend. The ADX is above its moving average. It's above 20. It shows a strengthening trend, and the green line is on top. With the up day, the bias is positive, and our momentum, the last 2, 3, 4, 5 days taken together, continues to be positive. So here we have the employment situation report. Non-farm payrolls came in at 227,000. They expected 200,000, so it was stronger than expected. But remember a month ago when we had first we were told that there were 12,000 new jobs. Well, it doesn't look much better, but at least it was revised up to 36,000. The private payrolls came in at 194,000, a little bit less than expected. But when we got this a month ago, it was a minus 20,000. That was revised up to a better number. It was still down 2,000, but at least it went in the job creation direction. So this is showing some improvement, and it's not necessarily suggesting that the at least the employment situation is falling apart. But the unemployment rate did tick up to 4.2%. That's what they expected, and it's up from 4.1%. Average hourly earnings a little hotter than expected. Might be a little bit concern of inflationary pressure there. Up 0.4%. They expected it to be up 0.3%. Last time it was up 0.4%. Consumer sentiment a little bit stronger than expected at 74. They expected 73.5. Last time we had this report, it was at 71.8. And then to get a year over year comparison, a year ago, it was at 69.7. Consumer credit. A lot of people are adding to their debt right now. It was up 19.2 billion, much more than the 10.5 billion they had expected. Last time it was up 3.2 billion. Okay, here are some charts. The average hourly earnings on a year-over-year basis, declining just a little bit, but still hanging around that 4% level. The payroll change, where we saw a big improvement over the previous reading that we had. And looking here, I have to move this bar. Consumer credit on a year-over-year basis. It's a little bit over the 2% level, but it is starting to go back up. Okay, and then the month-over-month change, where we saw a big bump up with the consumer credit there. So looking at Thursday's data and combining it with Friday's data, where the red line, these are the initial claims, which were starting to go back up after they had been declining. The continuing claims are starting to decline after they had been going up. And now we have unemployment back up to the 4.2% level here. And then consumer credit, seeing a real improvement across the board. The blue line, which is kind of, they're all jumbled together here, showing that we're looking a little bit more positive. And then the purple line is how people are feeling right now. That really saw a shot up here. And then the expectations are looking out into the future. That's also showing some improvement there. So then we plot this on this chart with the 2-year Treasury yield, where we're seeing the gap start to get a little bit closer, but still they're quite far apart now. And typically what we see is when consumer sentiment is going up, the blue line, which, yeah, it's been really jagged here, but the overall trend has been up. That tends to follow what the 2-year yield is doing too, even though interest rates have been coming down, at least recently. Okay, Isabel Net blog charts. This really cracks me up, and I like to make note of this every time I see this. The word here is arithmetic, okay? We all took arithmetic in school, but when you start talking about the stock market and technical analysis, they like to pronounce it differently. Arithmetic, okay, because it's logarithmic, and they try to line the two up, just make them sound all cool. It's arithmetic. This is the average annual real return based, so they're taking inflation into account of the S&P 500 over different periods. From 1900 to now, and of course, I'm sure a lot of you got into some investments back in 1900, 7.25%, and then you go to 1999, then we go from 2000 to now, 2009 after the great financial crisis, and how things have gone up since then, because 2022 is included in there, which was a difficult year. But even if you go from 2017 until right now, that's where we're seeing most of the gains coming lately. Okay. And then how many new highs have we had so far in 2024? They're right around 64, 60.3. I don't know how you get zero point 0.3 of a new high. It should be a round number. But this goes back to 1957 up to now. They're just estimating this, because there's still part of the year left. So it's during really solid years here, 1995. The 93, 94, 95, this is when I first started getting involved in the markets. And it was really going crazy there for a while. And then, of course, we don't get new highs when the markets are in real difficult times. But we'll have to see if any more are added. And this is going to get bumped up a little bit because this chart was created before Friday's close. And if you hear a cat in the background, he's just saying hello. 007. Okay, Wells Fargo, they're coming in saying they see 7,007 in 2025. All right, pick your number. Let's go for S&P 10,000. 10,492, just to come up with a number. Uh, People love projections, but I don't do that. I don't forecast things out. I don't know what the high and the low is going to be. The only thing we can do is evaluate where things are at right now and then make adjustments. That's why I rely so much on that daily videos and the daily analysis, because you can see these subtle little changes happening. Sometimes these little changes, we see them and then they develop into nothing, but we're still aware of them anyway. Other times, these little subtle changes do develop into something, and we see them happening before they really become big, and we can make our adjustments that way. All right, that's where I come out there. And then, of course, We have gold, and the folks here at Goldman Sachs think it's just going to the moon, where the futures are thinking it's going to the moon, but probably a little bit slower there. And this is where we're at right now. All right, U.S. equity market concentration today is particularly high relative to history. Okay, it just means that folks are in the stock market. It's still a good place to be and has been for a long time, but it goes in and out of favor. And there are fad things like the dot-com stocks, um, the cryptos, which when everybody's starting to do it, it's a fad, especially when they don't really know what they're doing in the market. They just think, oh, I can just automatically buy low and sell high, and I don't need to know all these intricate details of what's actually happening. Well, the stock market, it stood the test of time, and that's what I focus on and have for decades now. Okay. And then looking here at the post-Great Financial Crisis, exceptionalism is exceptional. All right. So it just says how, and I keep having to move this bar that you don't see, but I see it while I'm trying to record here. Equity outperformance since 2008 has been startlingly, it's not a word I say very often, consistent. This is the world performance relative to the S&P. So it's a little bit misleading. You can look at this chart and go, wait a minute. It just means that the US stock market, there's no other markets in the world that are outperforming the S&P 500. All right, and then this is another look at where we are at right now after the election, and then typically we compare it to 2016 because that's more of a direct comparison since that's when Trump won last time, and things ended up doing pretty good after that. And then the Magnificent Seven, they're up over 60% this year, probably a little bit more than that now after Friday's gain. And then there was one interesting chart that I found on Twitter. This is sector performance since the August 5th. Remember August 5th when the VIX went up to like 65 or something? And everybody was talking about it. It was pop news. We had the whole thing going on in Japan, the carry trade and all of that. Well, how have things done since then? Because the world was supposed to have ended on August 5th. Well, not according to this chart. And if you're familiar with the symbols here, for the different sectors, we can see that discretionary, which up until August 5th was really frustrating. If you go back to the videos I was looking or I was doing a year ago, last spring, early summer, it's like discretionary because Tesla was getting hit pretty hard then. It just wasn't doing all that well. Well, since that time, it's been the best performing sector. And then we have XLF, that's financials. They're still doing good. We keep an eye on that in case something happens with the like the great financial crisis, and sometimes we can get some leading indication that there's problems that are developing by keeping an eye on that area and other areas in the financial sector. But that's another strong area. And then I have communication, which is a growth area. And then XLK, that's tech. And then here's the NASDAQ 100 itself, which since last summer has been underperforming some of these other areas of the market. And then right underneath that, which has more stocks than the NASDAQ 100, since there's 503 stocks in the S&P 500, it's been doing quite well. And then the other areas like XLV, that's healthcare. And real estate, I mean, we actually have healthcare, which is down here, but some of the other areas which have been lagging behind lately. So this just kind of gives you a graphical representation of how things have been going. Okay, let's go back and talk about what happened. We set the high right, pretty much right after the open. The the initial reaction to the employment report was positive. So we shot up above R1. We didn't get up to R2, but see how we stalled out here at 6,100? Everything just kind of stopped right at that point. It's like, okay, are we going to break on through to the other side like Jim Morrison, or not right now anyway? And then we ended up pulling back after we weren't able to break out above that. We dropped down above or down below R1, came all the way back down to the daily pivot, bounced up off of that, came down to the daily pivot again. So we test this level twice, and we saw some strength going into the close. Now we closed off of the high here, but we did see some late day strength coming back in to actually improve things and close slightly above R1. And this, the futures were rather muted up until the employment report came out, and then we saw them shoot up. We saw the market shoot up and then come back down. And now things have closed for the weekend, and they'll start to trade Sunday afternoon or evening, depending on your time zone. Excuse me. Now, this is positive. We're still seeing the blue line above the red line. That's growth outperforming value, and that's what's helping the indexes to go up. We're also seeing this, and this is helping the S&P to go up. The growth to value ratio has been going up since the latter part of November. We've seen a real improvement here. And then end of day, where growth was up, value ended up being down, and growth was up, but up less for the mid caps, and it was actually down for the small caps. But we're seeing an overall improvement when we look at growth to value for the small caps. It's coming up. Now, if we stay above these lines, we're going to see a golden cross here, and that could be more positive for the small caps. Seeing an improvement here and getting close to a golden cross with the mid cap growth to value ratio. And we're finally starting to break out a little bit when we look at S&P growth to value. Now, this is positive for the market. We want this to keep going up, and that will help the S&P to continue to go up. If this starts to falter, that could put the S&P under some pressure. And we're also improving here. The growth versus value ETF, just breaking out above the rainbow, not quite back to the previous high that was set over the summer, but still looking a lot more positive lately. Discretionary, looking pretty positive now, has been performing well since the August 5th meltdown that lasted a day or two. But this going up is also more positive and will help the S&P to go higher. Large cap growth setting an all-time high. And I wanted to show the risk on versus risk off ratio here. We're going back up as the large caps or the high beta stocks, the mega caps, those stocks that everybody loves when they're going up. This ratio is starting to go up as well. So looking at our trend, we're above the moving average with the ADX. That's the dark black line here. And we're above 20. That suggests a strengthening trend. We're positive. We're a little bit concerned the green line didn't really go up, but it's still above the red line. So we are still positive. We also declined a little bit with the green line with the short term, but we're also showing a strengthening trend that's positive here. So we have a short and intermediate term positive trend. Volume was below average, which again is surprising with the huge report that came out in Friday's session. This is another look at sentiment here, the euphoria meter. It takes a whole lot of things and puts them together, and it's getting kind of high here. Now, the sentiment gauges that we look at are not extreme. They're neutral right now. But this one, and they don't, oh, here, it's the forward PE, which were overextended, were expensive, even looking at forward earnings. The VIX is really coming down, and then bullish sentiment, which I think they get from the American Association of Individual Investors. The sentiment gauge that we look at uses different things to be calculated, and it's more neutral, where this chart is actually looking extreme positive now. Could make the market vulnerable that way. And we're coming down with the VIX, both with the line chart and the bar chart here. When the VIX drops, the VIX of the VIX actually went up a little bit on a closing basis. It was lower, but ended up closing off of the, excuse me, closing off of the lows. The momentum for the VIX continues to be down. We're at 12.77 now, and these are very high readings. And this is when the market tends to perform well. But we don't know how long it's going to stay down at this level. If we start to decline with the S&P, the VIX is going to go back up. And we're getting a little extreme here, meaning we've been coming down pretty far, pretty fast with the VIX. And this is the overall tendency. And even though we tend to decline overall here, it's not a straight down move all the time. It's a jagged line as we go lower. And it, to this point, seems that we're playing out the way seasonally we typically do at this time of year. But we're getting an even higher reading now with the skew index. The market is still expecting some kind of a big move. Maybe it's to the downside now, because even with up days and setting all-time highs, this is still continuing to go up. What's it going to take to work this back down out of this red area here? Maybe a decline is still being anticipated. That's just a guess. It's pure speculation, because even though we're seeing some weakness, we don't have any real confirmation of, based on price, that things are starting to go down. And we're pretty much flat here with this fear gauge, and we were up with this other fear gauge. A little bit of a contradiction there. We're going back up with the equity put call ratio on the daily chart. Even though we had an up day, may have been some hedging going on ahead of the weekend. So there were more puts than calls being bought. But when we look at the 5-day chart, we're going down. And here's a longer term look at the 5-day chart. And we're also declining here with the 10-day chart as well. So that tends to be more positive for the market. But we saw a real spike up here with the volatility risk premium. We'd been below this band here for November and into December, and we shot up. So they're anticipating some kind of risk 30 days out from now. And so we just want to be aware of that. We're not seeing it in the VIX. We're not seeing it with other indicators that we look at, but we are seeing that here. Advanced decline line, setting an all-time high with the S&P, but we're going down based on price and volume. Longer term, we're still positive since we're above these advancing moving averages. Also, rolling over with our 5-day moving average of the highs minus the lows, going down with the 10-day. Now, we did set a lot of new highs, but we're seeing a little bit of an expansion here of the new lows. And this is internally what's going on in the S&P, setting an all-time high. We don't really want to see new lows being generated there. A little bit of a concern, but we're still positive. You see a lot more green here than we see red, but the red is increasing now. And we're still going down with the advanced decline ratio. Again, setting an all-time high, and both in the short 19-day and intermediate term 39-day continue to decline. And coming down a little bit, but still positive with the accumulation distribution. Here, that's a smart money indicator. Coming down here with the Chaikin money flow, and the red line is now starting to turn down. You see this little weakness that I've been talking about? You take all this together, the previous chart coming down a little bit, but still positive. This is coming down, but still positive. And we're going down, but still generally positive with the Chaikin oscillator. So we're not seeing an awful lot of confidence right now with our smart money indicators. And we want to be doing what the smart money is doing. However, when you look at the vortex, we really shot up with the green line and we're going down with the red line. So this is turning more positive. And we're still looking good here with the 10-day average of the highs and lows for the S&P. Still getting a very, very high reading. This is more positive, intermediate to even a little bit long term. And this is a broad market measure with the 5-period moving average of the highs and lows, still above zero. But we're seeing a bit of a disconnect here. We're going up with the S&P, we're going down with the NYSE advanced decline line. And coming down with the cumulative advanced decline line for the S&P based on price and volume, even though it set an all-time high. Also, the broader market, cumulative advanced decline line, coming down but still above the moving average. Also, with the regular NYSE advanced decline line coming down but still above the moving average, also being confirmed here by a slightly different NYSE advanced decline line. And coming down with the common stock based on price and volume for the NYSE. And we're seeing a little bit of a deterioration here with the advanced decline line studies coming down, excuse me again, but still above the moving average with the NYSE common stock, declining with the S&P, coming almost down to the moving average with the mid caps and pretty much flat here with the small caps. Now, these are still positive since they're above the moving average, but they are showing some weakness right now. And we're actually dropping below 50 with those stocks in the S&P above their 20-period moving averages. That's short-term negative, showing some weakness there. It's just a few stocks that are above their 20-period moving average. Most of them are actually going down now. And we're declining, but still positive with the 50-period moving average study, also declining with the 100 and the 200-period moving average study. So in the short term, setting a high here, we still have a ways to go to get to this dashed line, which could be acting as overhead resistance. Looking positive here. This is a really strong looking chart taken together, but we did drop to below average when we look at volume, or we're declining with the 20, 50, and 200-day moving average study of the S&P, getting a little far away from the 20-period moving average and from the 50-period moving average. Excuse me, having to clear my throat here. But our short-term indicators, the Stochk RSI is extreme, as is the Williams percent R, CCI 14, and the CCI 20, showing good momentum, but looking a little vulnerable right now, too. The Stochk RSI is extreme, excuse me, the stochastic in the short term is extreme, rolling over a little bit, but still extreme in the intermediate term, still extreme and not quite below the moving average with the long-term stochastic. Still slightly above the midpoint here with the force index. So that's hanging on to being positive, but it is declining a bit here. Still looking okay with the short-term trend based on 20 periods. We're above the green line and the blue line, and the lines are going up and prices above the lines. Still above the 20 period simple and exponential moving averages here. Very positive that way. Still in the +3 channel with standard deviation. Now that's positive, but sometimes we get up to this area and we might not stay there for very long. But there have been other times when we do camp out up here. Last summer, we just camped out in the +3 channel for many trading days. Intermediate term, just getting an extreme reading here with the balance of power. We have not seen one of those since last summer. Coming down, but still extreme with the CMB composite. And the intermediate term trend still looking good. Above the red line and the blue line, that's quite positive there. We're still positive with the go, no go with the darker blue bars. The blue line here for the highest high value continues to go up. That's positive. And we're seeing a little bit of an improvement here. After we have been declining with the TTM squeeze, it's finally kicking back into gear and turning more positive. And we're still looking positive here with the ease of movement. We're above zero and going up. The Erin indicator continues to advance and is above zero, so that's positive there. But when we look at the S&P McClellan oscillator, we continue to drop further below zero. And so that's turning the summation index based on price down, and we're also declining based on volume. And we're dropping negative here with the NYSE McClellan oscillator below zero. So we're rolling over here with the NYSE summation index based on price and volume. This is some of that more broader market weakness that I've been talking about. And here's another look. We're negative with the Swenlin trading oscillator based on price. We continue to decline here, and now we're dropping further below zero here based on volume. But the momentum is still looking positive. But there's something interesting I'll show you in just a moment. We're still going up here with the PMO. That's positive. But let's see how we're rolling over based on price and volume. So the indicator's looking solid, but breaking it out a little bit here is not looking all that positive currently. This is the interesting part. Setting an all-time high with the S&P. Now the PMO, it's the price momentum oscillator developed by Carl Swenlin. Been around a long time. I use a lot of his indicators. And then he's developed a lot of studies that go with the PMO. That's why you have additional charts here. And he breaks it out into a study, the PMOs that are rising. Okay, we're going down here. The buy signals that are being generated according to the price momentum oscillator going down, and we're declining here with the PMOs that are above zero. So this is more of that internal weakness that we're seeing, that we're not seeing reflected in the price of the S&P, but we're seeing it developing inside of the S&P. And now this is kind of crazy, where we were going down with the slope oscillator, and it was like our one outlier with our momentum oscillators. Now it's starting to turn back up and crossing back above its moving average. But the MACD, that's still looking positive, and we're turning back up with the slope oscillator. We never did really look all that weak with the TSI, which is our other short-term oscillator. The intermediate term oscillators and the long-term oscillators continue to be positive. So momentum is still there. We're just seeing some internal weakness in the S&P right now that hasn't really come through to price yet. Now we're turning back positive with the Copic curve. It had been negative, now it's turning back positive. And we came down a little bit here with the Sean trend meter, but we're still looking quite positive there. Getting extreme positive with the money flow, and actually declined a little bit with the ultimate oscillator, but still above 50 on balance volume. So we had an up day. We're above the advancing moving average. And the Pring bottom fisher. And as I've been pointing out here, this signal was actually generated right as we were chopping sideways there for a number of days in November. This crossed and actually gave a pretty nice little buy signal there, even though that's not really what this indicator is supposed to show. It's when we've really been declining and then we start to come up out of that. That's what this indicator is supposed to tell us. But we're just coming off of a recent all-time high here. You don't call this a crash, but it ended up being a pretty good signal there. The RSI intermediate term, based on 14 periods, still looking good there. We're extreme with the short-term RSI. And we are still neutral with the Elder's Impulse system for the S&P, but we're still positive with the parabolic SAR since the dots are underneath. Moving averages still looking really solid there. We actually declined a little bit with the bullish percent index. Now we're getting a positive reading and we're above 70, but to have us going up with the S&P and this to tick down, another little warning sign of weakness that may be developing. We're coming down with the NYSE bullish percent index here, but we did see a decline with the NYSE. Flat right now, but getting an extreme reading and quite positive here with the NASDAQ 100 bullish percent index. And this is where a lot of the strength is coming from. And stocks that are in the NASDAQ 100 are also in the S&P 500, so that's what's helping the indexes. Okay, now longer term, we're just bumping into this longer term trend line. There's nothing magical about it. It kind of matches up with some resistance that we saw back in 2014 and 15. I'm sure you all remember that. But then at the end of 2021, we actually broke above this. And that's what we're trying to figure out now. Are we going to break out above this longer term, or is this going to provide some longer term overhead resistance? And it's going to take some time for that to actually play out. That's why we keep watching this. But when you look at things based on the trend, Heiken Ashi, positive. Kegi, positive. Renko chart, positive. Three-line break, positive. Long term, I wanted to show this. I've dropped this chart for a few days now, but when we look at the 150 and 200 period moving average study, we're actually going down. We're dropping below this red line, even though we're setting all-time highs with the S&P to see our longer term moving averages decline. Again, it's not saying things are falling apart. It's just saying, we're seeing some weakness that's developing here. But we're still positive with the Keller market model across all time frames and all the indexes. No changes here. I don't know if somebody hasn't updated it or what, but the charts on the stockcharts.com site haven't changed all week. And then we have discretionary, communication, and tech. These are the three big growth areas, and they were up. And that's what helped the S&P, where we have the rest of the sectors led by energy going to the downside. We also saw utilities and healthcare. These could also be taken as more defensive areas as well as staples. They saw more weakness. As growth had a good day for the S&P, and the more defensive areas saw really didn't have a very good day. So we had Canada, good old Canada, setting another new all-time high there. The S&P setting an all-time high, the Nasdaq all-time high. We had the real estate. We had a bearish MACD crossover. This is when the 50-period moving average crosses below the 200, and that's what I use to define the long-term trend. We had the materials had a BPI back above 50, so that's turning a little more positive. But discretionary, after getting a really high reading above 80, it's now starting to cross down below that. But discretionary ended up having a good day and it's still looking solid. We'll want to see, is there some weakness starting to come into that area that may have an impact on the market shorter term? And here we're also seeing a disconnect. The S&P is going up. That's the weighted version, the bar chart, where the red line is the equal weight. It's been going down. And we're seeing a real change here when we do a ratio between the weighted and equal weighted version. This continues to go up, showing that the bigger stocks are outperforming. And coming off of a new all-time high here with the S&P and also a new all-time high with the Nasdaq. So that's a confirmation there. The Dow is down a little bit after setting a recent all-time high, and we continue to be neutral with the diamonds with the Elder's Impulse system, setting a high and going above this R1 level now. That's looking really good for the Nasdaq. Also above this R1 level too with the Nasdaq 100, setting an all-time high. We continue to be positive with the Qs when looking at the Elder's Impulse system. The momentum for the Nasdaq 100 is now back to comfortably positive. Small caps, up 0.1%. Hey, whoopee. After really shooting up, and it's what everyone's talking about, and everybody's sure that small caps are going to take off and go to the moon. Look at how they've been coming back down, which is similar to the pattern that we've been seeing for the last year. Now, this could resume its upward trajectory at any time, but it's just kind of real disappointing to see all of the moves come in a really short period of time and then a slow give back. And still above 50 though when we look at the Russell 2000 small caps with the RSI, But the momentum now is shifting to down as we've been drifting off after we set this high and then been coming back down since then. And we've gone from neutral to, excuse me, negative to neutral with the small caps, though. So a little bit of an improvement there then. With this, now this is the IWM, where the other index that I look at is the S&P 500 small cap index. This was up a little over a third of a percent. And the mid caps were up 0.08%. Woohoo! But also drifting back down after really seeing a nice little run up there. But we are seeing the growth to value ratios inside of the small caps and mid caps improving. So, and that's what I showed earlier in those charts, but we're still neutral here when you look at the whole mid cap index together. And I couldn't really tell here. Is this an all-time high? But we're getting really close here with the Wilshire 5000. Also, probably setting a new all-time high with the total U.S. stock ETF. So that's still looking good. And this is the big stock index, the FANG index. Facebook, Apple, Amazon, Netflix, Google, Nvidia, and some other high-flying stocks finally coming back, and this is where we're seeing the strength at right now. This is what we wanted to see, and now we're seeing it. But are we seeing it at the expense of the rest of the market? It'd be nice if these were moving more in tandem right now, and that could change. But it's actually there. We're seeing a bit of a negative divergence right now. And then we're coming right up to the underside of this short-term trend line. Is this going to produce some overhead resistance? It has before here. Now, other times it didn't, but we're really focusing on the most recent times now to see if that's going to add any overhead resistance to the FANG index. And Apple was down 0.08%. We had Amazon up almost 3%, setting another new all-time high. Microsoft up 0.21%, still above the 50 and 200-day moving averages there. Google was up 1.2%. Meta setting another new all-time high, up 2.44%. Nvidia was actually down 1.81%, but still above its 50-day moving average there. Tesla was up over 5%. Now, looking pretty solid, and this is helping discretionary. And Netflix, apparently they're coming out with a lot of good movies right now, setting another new all-time high. And still seeing a general improvement here when we look at US stocks versus world stocks in the short term. This is getting stronger, and we're seeing an improvement longer term with the correlation based on 50 periods. We're keeping an eye on the semiconductors. They were up 0.6%, not a gangbuster day, but they were up, but they're still below the 50 and 200-day moving averages, and we're still seeing a recent death cross here. We want semiconductors to do better if that's really going to help the overall market. And the dollar ended up being back up, seeing a recent golden cross here. That could end up pressuring stocks. Stocks tend to like a weaker dollar. And we were down. We broke below the 50-day moving average here with the 10-year yield, and we're breaking up above the 50-day moving average with the 10-year based on price. So interest rates going down seems to be helping stocks right now. And we are looking pretty good here with our growth to value ratios. Excuse me. The growth to value ratios going up with the Qs to S&P. Look at how discretionary is just really shooting up here. You might even say we're getting kind of far away from that moving average and we're really moving up kind of quick. Maybe we're due for a bit of a pullback. Now, we don't know. There's no evidence of that yet. We just see this on the chart and go, okay, we need to keep an eye on this. And we are seeing a real improvement when we look at large cap growth versus large cap value. And this is what we want to see. And we're also seeing an improvement here with the large caps, mid caps, and small caps. And I haven't shown this chart in a little while. We're seeing this going back down with the ratio from staples to S&P. And that's positive. When this goes down, that means the S&P is going up and outperforming staples, which staples are more defensive. Okay, what's our outlook for Monday? We're still positive. We have positive seasonality even for Monday's session, but we do see this weakness that's been coming into the market that I tried to point out here. We're going to get wholesale inventories, which is not a major economic report, and then all the crazy stuff going on in the world. The market seems to be in its own version of reality right now and is really just not paying attention to all these crazy things. And France is actually up on what's going on there with her whole prime minister no confidence vote and all that stuff. Okay, here's the economic calendar for the upcoming week. On Tuesday, we're going to get productivity and unit labor costs. And here comes the big ones. CPI on Wednesday, and then we're going to get jobless claims and PPI on Thursday. That's kind of big. And this is the upcoming calendar for the week. Here are the major reports that'll be coming out. Seasonality, we're positive for December 9th. Really quite positive going back over the last 21 years. And here we go. December tends to be strong when we're up over 10% after we get through, what is that, June? We're up 100% of the time. Well, looking pretty good so far there. And here is some positive seasonality going into the ninth. Now, after that is when we often see with the S&P some weakness during an election year that goes through pretty much next week. So we'll have to see. Is it going to play out that way? We don't know, but this is just something to give us a little bit of a guide to look at here. And I've been showing this where from the Tuesday before Thanksgiving to the second day of the year, up solid with the S&P and with the small caps. Monday in 2023 was the most positive day of the week. It's still a positive day, but not as much as Friday is in 2024. So the warning signs, we're still looking negative now with the S&P and NYC McClellan oscillators. They're below zero, which is turning the summation indexes down. The Copic curve, but it is in the process of turning back positive right now. And we do have a non-confirmed Hindenburg omen. And the Swenlin trading oscillator, that's another warning sign that we're seeing. And the 20 period moving average studies actually dropped below 50. Okay, then here are smart money indicators. They're positive, but accumulation distribution coming down a little bit on an up day. The Chaikin money flow, that's starting to show some weakness, and the Chaikin oscillator is actually going down right now. The 5 and 10 day charts for the equity put call ratio, they're still going down, and that's positive. Now, going back to the smart money indicators, they're still positive, but we're seeing them show some weakness here too. The vortex is positive and actually looking pretty strong right now. We're growth to value looking really good. Discretionary to staples looking really good. Maybe a little too good here. And our momentum oscillators are positive, and now the slope oscillator is starting to, oh, wait a minute, maybe I should go up after all. And I had the Copic curve on the previous, that was actually a mistake. It's actually turning positive here on this slide. The advanced decline lines, we are seeing some weakness, but they're still positive since they're above their moving averages. And we have the 50, 100, and 200 period moving average study, where the 20 period has now dropped below 50. Even though, but these are declining, these moving average studies. Parabolic SAR, though, it's positive. And the bullish percent indexes, still positive, although we are ticking down with the S&P and NYSE. We were flat with the NASDAQ 100 and still getting an extreme reading there. The ease of movement, money flow is now extreme, and the ultimate oscillator, those are still positive. The momentum for the NASDAQ 100 and the financial sector, even though it's been under a little pressure lately. And then we have this Hindenburg omen. And if you're watching this video for the first time, you can read through all of this stuff here and see if it cures any kind of insomnia that you may have. But what I like is that stockcharts.com took all the criteria on the previous slide and put them into one chart here, and we're waiting to see if another spike comes up, and that's not happened. And we had the initial spike on November 20th, and we have until December 19th to get another spike here. So at this time, this is a non-confirmed Hindenburg omen, which is a negative thing for the market. Okay, our conclusion. Positive seasonality, weakness developing. I haven't changed the conclusion here. I haven't changed this either. We are still positive in the short term, and we're positive as far as seasonality, at least through Monday. We'll have to see if things change after that. Intermediate term, this is where we're seeing some weakness develop. We are still positive in the long term, even though we've been seeing our longer term moving averages actually coming down a bit. They're still quite positive, though. Thank you. I really hope you have a great weekend, and I will talk to you in the next video.